It's a beautiful day, perfect for a hike. Before you head out, you grab your trusty backpack and start filling it with the essentials. I know. You came here to learn about starting a portfolio, but follow me for a minute. An investment portfolio is sort of like that backpack, but instead of holding your hiking supplies, your portfolio holds everything to do with your investments. Starting with your approach, the map, if you will, or plan you're going to use to guide your investing decisions. You probably have various supplies and food in your backpack to help keep you safe and comfortable on your hike, much like the diversified assets you'll decide to buy. What goes in your backpack can be taken out at any time, like cash in your portfolio or investments that you can sell quickly if you need some fast money. You can also choose to fill your backpack with extra supplies, just like lump sum deposits that can help your portfolio grow. And your backpack might have different pockets and compartments for different needs, much like the different investment accounts you might open. And you wondered where I was going with this. Now, I think you'd agree that building a portfolio is a little more complicated than filling a backpack. But have no fear, I have 4 questions you can ask yourself to chart a course. First, what is your investing goal? One of the most common reasons people start investing is to save for retirement. This is a great goal to have, and the earlier you start working towards it, the better. But there are so many other goals you can have too, like buying a new car or a home or maybe traveling. Your investing goal can be anything you want it to be, and deciding on 1 or 2 or 3 is the first step towards defining your investing plan. This plan is what allows you to focus on the bigger picture over time, meaning you're less likely to make snap decisions that could move you away from your goal. Now, it's best to be specific when plotting out your goals. Identify what you want and when you want it. This can help you determine which investing accounts you'll use and how long you'll be investing. Next, how much risk are you comfortable taking on? Start by asking yourself, how would I feel if I lost half the money I invested overnight? From there, you could start to identify what's called your risk profile. Everyone has one, and it plays a big role in helping you figure out what goes into your portfolio. And I don't just mean products. Think bigger. Which industries will you invest in? Which parts of the world? But before you get to this point, risk is the name of the game. So check out our video, What Type of Investor Are You?, to learn how to figure out the right amount of risk that's right for you. Moving on. How involved do you want to be with your investments? There are 2 aspects I want you to consider here. How much time do you want to spend deciding what to buy? And how often do you want to keep tabs on your investments? Let's start with that first one. Say you're keen on adding individual stocks to your portfolio. Ideally, you'd spend some time researching companies that interest you. You could start by reviewing each company's reports, financials, and larger industry trends. You could even go so far as to compare how each company's values align with yours. Needless to say, there can be a lot to consider when buying individual stocks. If you don't want to be so involved, you can choose larger, broader investment funds that can be made up of literally hundreds of stocks and other products as well. Of course, you'll still want to spend some time on research, but it'll be far less than if you were buying individual stocks. On to the next consideration. Tracking performance. Periodic pulse checks are great for a few reasons. They let you see if you're on track to meet your goals, and they help you determine whether your goal is realistic. For example, maybe you need to extend your investing time frame. They also give you an opportunity to adjust something if anything changes in your life, like maybe you've had a bump in income, or maybe you're expecting a new addition to the family. Whatever the reason, keeping track of your progress can help you decide whether you need to adjust anything. How often you do this is up to you, but many investors check at least once per quarter. Whatever you decide, use a calendar to create reminders. Lastly, how much will you invest and how often? It's not just the value of your investments that help your portfolio grow over time. Other factors can affect this too, like the deposits you make. Regular funding can help you reach your goal, and it can help get you there faster. That's the beauty of compound interest, which is the interest you earn on both the money you're contributing and the interest you're already earning on it. If you're comfortable contributing often, say monthly or even bi-weekly, you can set up automatic deposits. This can be done using a monthly contribution plan or a systematic investment plan if you're contributing to a mutual fund. This will allow a fixed dollar amount to be transferred into your investing account on a regular basis. The exact amount and frequency are up to you. Answering these 4 questions is a great way to start building your portfolio. And just like packing a backpack, a little preparation can go a long way to helping you feel safe and comfortable later.